We see the market falling once again today, 1% in the red. Where did we see selling pressure particularly coming through on the market?
Most of the sell side was on the commercial side and on the industrial side, where companies like Eveready, East Africa Breweries had a bit of downward pressure on them. On the commercial side, we are looking at Standard Group, Safaricom, and Car in general, basically. And the pressure comes in through because of, if you look at those two industries, those two sectors, EABL, with the demerger from SAB Miller, their prospects don't look that good. If you look at Safaricom, Car in general, maybe in Standard Group, the commercial side also doesn't look that well. Maybe marketing expenditure might be cut slightly this year as the economic outlook does not look that well.
Let's look at the shilling, because of course that's been a big topic of debate lately. We have had thin liquidity in the market today, but we have seen it firm slightly since the central bank placed restrictions on overnight borrowing from the discount window, and also after decreasing that window rate from 8% to 6.25%. What has the market reaction been to these moves?
Okay, really, I don't think the shilling is really reacting to the central bank cutting their rate from 8% to 6.5%. Actually, them cutting their rate to 6.5% might actually spare the shilling to weaken further. Because that's more of like, because if you cut your central bank rate, your reserve rate, it's rather contrary to fighting inflation. Because if you want to fight inflation, you want to tighten the monetary policy, not to weaken it. But basically, the shilling strengthened because naturally the dollar has weakened in a day or two because of the debate on the debt ceiling, and the euro also falling. So that's how the shilling has benefited actually.
So it's really dollar strength rather coming through, and risk aversion as opposed to particular shilling movements there.
Yes, actually, basically, it's the shilling benefiting from the dollar weakening and the euro slightly weakening against other currencies.
But overall, it still remains extremely weak at this stage. It's still teetering around that 90 level to the dollar. It's off its a record low of 91.90. What is your outlook for the shilling going forward, seeing as we still have surging inflation?
It should remain around that amount, if not to weaken slightly as we get closer to the end of the year. The issue being one, we foresee dollar inflows into the country coming a bit lower as exports suffer also because of the current drought. Was agriculture and horticulture are the major exports, and production yields in these sectors have been low. Also, if you look at the inflation level and vis-a-vis the inflation of the surrounding countries or our trading partners, you'll find the shilling actually supposed to be that weak at those levels.
Let's look at positioning yourself in the market at this stage, given the bloodshed, one could call it, perhaps, on the market. We've had most stocks performing poorly. How would you be positioning yourself to be defensive at this stage?
I guess it depends on the strategy or the type of funds you're actually investing in the market. If you're investing long-term funds, this is the time you start accumulating stocks at cheaper prices. I don't think the market has reached a bottom yet. If you look at the technical side of the market, then you can see it reached an overbought position and it has to correct. So it's not really that stocks are at a bargain. They are not at a bargain. They're actually correcting. So an issue of timing plus just accumulating counters that have correct fundamentals, but we're slightly a bit overpriced, and the price is just correcting.
So where do you see the value coming through? Where are the counters that have a long-term earnings potential that you'd be buying into at this stage?
Okay. If you base your stock picks on fundamentals, that the best short-term or medium-term investment to make, it will be into the financials. As interest rates go up, we expect their interest income to go high, especially for the bigger banks who can negotiate their deposit rates a bit lower. We're looking at the banks like Barclays, Standard Chartered, Equity Bank, and Cooperative Bank, who will be good buy into. However, again, I still put caution. It's an issue on the timing at which price you enter and when you want to go out. But the financial sector looks pretty much set, as it will basically ride this wave that we are seeing in the market currently.
We're expecting results out of some of the financials next week. Let's look at KCB. There's been a lot of activity around that stock. 15.8 million shares of those, that stock changing hands today between 22.5 shillings and 23.25 shillings. Now, investors appear to be positioning themselves ahead of the release of the company's results. Speaking to a trader this morning, she was very bullish on the earnings potential of KCB going forward. They've been restructuring. They plan to extend into the mortgage market in the region. What are your thoughts on this company?
If looking at KCB, maybe not in isolation, but on the whole financial sector, if you've noticed this year, there's been a lot of restructuring, or should I say there's a lot of cutting of costs. And when companies start cutting costs, it means the revenue line in the short or medium term is not growing as fast enough as they want it to be. So yes, because of the costs that they have cut, their earnings will be well. But whether it will drive their stock price up is also a different story, because the market seems to be reading from a different script than the fundamentals of the companies.